Let's begin with the basics. A central bank digital currency, CBDC, refers to a virtual currency that is issued and backed by a central bank, such as the Federal Reserve in the case of the United States. Unlike CBDCs, stablecoins like USDT and USDC are cryptocurrencies issued by private enterprises and pegged to other assets. It's important to note that CBDCs differ significantly from decentralized cryptocurrencies like Bitcoin, since CBDCs are centralized and operated by the state. Now, why would the US government and the Federal Reserve consider creating a CBDC? There are several reasons to consider. Firstly, the US doesn't want to fall behind other countries. Currently, 87 countries have shown interest in CBDCs, with 65 of them being in advanced stages of development, and 20 central banks have already launched pilot programs. China, for instance, showcased its CBDC during the 2022 Olympics in Beijing, where athletes and visitors used the digital currency for purchases in the Olympic Village. China's pilot program has expanded to 25 cities with a focus on experimentation and learning rather than widespread adoption. In select cities, public sector workers, including government employees, schools, hospitals, and media personnel, are being paid in CBDC. Additionally, the CBDC can be used for utilities, transportation, tuition, tax payments, and more. China currently has the largest CBDC pilot program with over 260 million wallets in circulation. As China progresses with its CBDC and with other 20 countries in the pilot phase, the United States is experiencing a fear of missing out, and so began exploring CBDCs a few years ago, currently in the research stage. Considering that the US dollar is the world's reserve currency, it's crucial for the US government and Federal Reserve to examine whether a CBDC would help maintain the dollar status. However, the Federal Reserve has stated that they will only issue a CBDC if Congress and the executive branch support the initiative. It's important to remember that the Federal Reserve as a central bank is an independent entity separate from the government. In addition to the FOMO aspect and the risk of falling behind, there are other factors influencing the consideration of a CBDC in the US. The implementation of a CBDC is seen as beneficial by the federal government and the Federal Reserve for several reasons. First, they believe that a CBDC would enhance payment efficiency and reduce transaction costs. By introducing programmable money, the Federal Reserve and the government would have the ability to freeze funds if an individual, institution, or country engages in activities deemed unfavorable. Moreover, a CBDC would provide greater transparency in money flow, enabling the Federal Reserve and the government to monitor and track financial transactions and expenditures more closely. This increased visibility ensures that they can observe how individuals utilize their funds at all times. Proponents argue that a CBDC could potentially assist the unbanked population in the United States, offering them access to a digital payment system and potentially expanding financial inclusion. However, it's important to note that these advantages are presented from the perspective of the government and the Federal Reserve. Whether these advantages are viewed as beneficial by individuals or other stakeholders may vary. These advantages are not exhaustive, but they represent some of the primary ones that are frequently discussed. There are numerous concerns and problems that have been raised regarding CBDCs, and it's essential to address them individually. Let's begin with the notion that a CBDC would benefit the unbanked population in the US. It is true that some individuals in the US do not possess bank accounts. However, it is crucial to consider the global perspective. Worldwide, approximately 2 billion people lack access to traditional banking services, but surprisingly, 80% of them own smartphones. The argument suggests that if individuals without bank accounts possess smartphones, connecting them to a CBDC would improve their lives and contribute to global betterment. Nonetheless, there is a significant issue with this narrative, particularly when applied to the US context. While it may seem logical to assume that a CBDC would assist the 4% of the US population without bank accounts, there is a problem. Surveys reveal that 40% of the unbanked population in the US willingly choose not to have bank accounts due to a lack of trust in financial institutions. These individuals harbor skepticism towards banks and consciously refrain from opening checking accounts. Given this, it is doubtful that these same individuals would readily embrace a CBDC. It's important to acknowledge that the reasons behind unbanked populations can vary significantly across different regions. Looking at another argument favoring CBDCs, proponent claims that CBDC would bring about a more efficient payment structure and lower transaction costs within the banking sector. However, this claim is soon to be outdated. The Federal Reserve's instant payment network is set to launch this summer following extensive work on upgrading the payment infrastructure since 2019. Once implemented, financial institutions will be able to send and receive payments 24/7, establishing a real-time payment system in the US. This modernization implementation of the system will diminish the previously touted benefits of CBDCs in terms of payment efficiency and cost reduction. Moving on to the next features that the government favors in a CBDC, programmable money and increased transparency in money flows, we must question whether we want the government to have detailed visibility into our purchases, timings, and locations. The transparency provided by a CBDC would grant the government access to such information. The government argued that this increased transparency would help in capturing tax evaders, preventing money laundering, and curbing illegal activities. Additionally, the programmable nature of CBDCs would enable the government to exert significant control over individuals' finances, including the ability to freeze or confiscate funds with a simple click. This understandably raises concerns among many individuals who value their privacy. It essentially implies that the US government could have extensive surveillance capabilities. Even if individuals are not engaged in any illegal activities, privacy is still a fundamental right that should be respected. With that, Republicans are staunchly opposed to the implementation of CBDCs, warning against the potential tyranny associated with them. In the Senate, Senator Ted Cruz introduced legislation to prohibit the Federal Reserve from issuing a CBDC that could be exploited as a financial surveillance tool by the federal government. Cruz emphasized the importance of enabling cryptocurrency to thrive in the US while preventing big government from centralizing and controlling it. Senator Braun, a co-sponsor of the bill, echoed these sentiments, emphasizing the need to protect privacy rights from further encroachment by the federal government. Similarly, in the House of Representatives, Majority Whip Tom Emmer introduced the CBDC Anti-Surveillance State Act. This legislation aims to safeguard financial privacy rights by preventing CBDCs from becoming tools of surveillance. Emmer stressed the importance of upholding American values of privacy, individual sovereignty, and free market competitiveness, warning of the dangers posed by a surveillance-oriented CBDC. At the state level, Governor Ron DeSantis of Florida signed a bill into law that explicitly excludes CBDCs from the definition of money. DeSantis highlighted the inherent danger of such arrangements, arguing that Americans should be able to exercise their independence without the government tracking every transaction they make in real time. Similarly, the Texan legislature introduced a bill banning CBDCs in the state. Finally, let's look at what the Federal Reserve is putting out in information about CBDCs. This coming from the Federal Reserve website. While the Federal Reserve has made no decisions on whether to pursue or implement a CBDC, we have been exploring the potential benefits and risks of CBDCs from a variety of angles, including through technological research and experimentation. Our key focus is on whether and how a CBDC could improve on an already safe and efficient US domestic payment system. CBDC is generally defined as a digital liability of a central bank that is widely available to the general public. Today in the United States, the Federal Reserve notes, i.e. the physical currency, are the only type of central bank money available to the general public. Like existing forms of money, a CBDC would enable the general public to make digital payments. As a liability of the Federal Reserve, however, a CBDC would be the safest digital asset available to the general public, with no associated credit or liquidity risk. The Federal Reserve Board has issued a discussion paper that examines the pros and cons of a potential US CBDC. As part of this process, we sought public feedback on a range of topics relating to CBDC. The Federal Reserve is committed to hearing a wide range of voices on these topics. My question to you, are you on board with CBDCs? And if you are not on board, is there anything that could be done to get you on board, or is it overall inherently a bad idea?